The economic fallout of weak November data after a 43-day U.S. government shutdown. Implications for markets, policy, and strategic outlook. Executive summary. The unprecedented 43-day U.S. government shutdown that ended in mid-November 2025 has left a profound mark on the economic landscape. The resulting delay and impairment of critical economic data, especially on jobs, inflation, and GDP, has created a data vacuum that complicates the Federal Reserve's policy decisions, heightens market volatility, and undermines both consumer and business confidence. As the backlog of economic reports begins to clear, the prospect of a weak November data release looms large, with the potential to trigger significant short-term market reactions, influence the trajectory of monetary policy, and shape the strategic responses of businesses, investors, and policymakers. This report provides a comprehensive analysis of the potential impacts of a weak November economic data release in the wake of the shutdown. It examines the implications for labor markets, inflation, GDP, Federal Reserve policy, market volatility, investor sentiment, consumer and business confidence, credit conditions, and the broader political and fiscal environment. Drawing on a wide array of recent data, forecasts, and expert commentary, the report also explores the short dash, medium dash, and long-term strategic ramifications, including the risks of policy missteps, persistent inflation, and structural economic challenges. 1. Introduction. The context and significance of the data vacuum. The 43-day government shutdown, which ended on November 12, 2025, stands as the longest in U.S. history, surpassing previous records and creating a unique set of economic and policy challenges. The shutdown halted the operations of key federal agencies responsible for collecting and disseminating vital economic statistics, including the Bureau of Labor Statistics, BLS, the Bureau of Economic Analysis, B, and the Census Bureau. As a result, the release of critical reports, such as the Monthly Jobs Report, Consumer Price Index, CPI, Producer Price Index, PPI, and GDP estimates, was delayed or, in some cases, permanently impaired. This data blackout has left policymakers, investors, and businesses flying blind, forced to rely on alternative, less comprehensive data sources and anecdotal evidence to gauge the health of the economy. The delayed release of November data, especially if it confirms a weakening trend in jobs, inflation, and GDP, could have outsized effects on market volatility, monetary policy, and economic sentiment. 2. Labor market implications. Weak jobs data and unemployment dynamics. 2.1. The state of the labor market pre- and post-shutdown. Prior to the shutdown, the U.S. labor market was already showing signs of cooling. The September 2025 jobs report, released with a 6-week delay, indicated a modest gain of 119,000 on-farm payroll jobs and an uptick in the unemployment rate to 4.4%, the highest in 4 years. Job gains were concentrated in healthcare, food services, and social assistance, while sectors such as transportation, warehousing, and federal government employment contracted. Notably, federal government employment had declined by 97,000 since January, reflecting both policy changes and the impact of the shutdown. The shutdown itself led to the furlough of approximately 750,000 federal workers, with an additional cohort working without pay. The Congressional Budget Office, CBO, estimated that the shutdown would temporarily boost the measured unemployment rate by up to 0.4 percentage points in October, as furloughed workers were counted as unemployed on temporary layoff. However, due to the cessation of data collection, the October jobs report was not published, and the November report was delayed until mid-December. 2.2. Alternative labor market indicators during the data blackout. In the absence of official data, policymakers and analysts turned to alternative sources, including private payroll reports, e.g., ADP, state-level unemployment insurance claims, and real-time labor market indicators from the Federal Reserve banks and private firms. These sources painted a picture of a labor market at stall speed, with job creation slowing to a crawl and layoffs rising, particularly in sectors affected by automation and trade policy shifts. The Chicago Fed's nowcast of the unemployment rate for October predicted a moderate uptick to 4.4%, with the shutdown likely adding at least 0.1 percentage points on top of the September reading. The Challenger, Gray, and Christmas index of job cut announcements spiked in October, led by technology and warehousing sectors. Surveys of employers and workers indicated a steady decline in job availability and hiring plans, with large employers predicting the weakest job market for new college graduates since the pandemic year of 2021. 2.3. Implications of a weak November jobs report. A weak November jobs report, characterized by minimal or negative payroll gains and a further rise in the unemployment rate, would reinforce the narrative of a softening labor market. Such an outcome would likely undermine consumer confidence, especially among lower and middle-income households who are most vulnerable to job losses. Increase pressure on the Federal Reserve to prioritize employment over inflation in its policy deliberations. Prompt businesses to delay hiring, reduce hours, or implement further layoffs, particularly in sectors already facing headwinds from automation, tariffs, and weak demand. Exacerbate disparities between prime and subprime workers, as banks tighten lending standards and credit becomes less accessible to those with weaker financial profiles. The labor market's fragility is further highlighted by the collapse in net immigration, which has reduced the break-even rate of job creation needed to maintain a stable unemployment rate. With monthly payroll gains averaging only 75,000 from January to August 2025, and the break-even rate now much closer to zero than at 200,000, even modest job losses could push the unemployment rate higher. 3. Inflation implications. Weak CPI/PCE prints and inflation expectations. 3.1. The inflation landscape, stubborn pressures and data gaps. Inflation remains a central concern for policymakers and markets. After peaking in 2022 to 2023, headline CPI and PCE inflation moderated, but have shown signs of reacceleration in recent months, driven by persistent core services inflation, elevated shelter costs, and the pass-through of new tariffs. The delayed release of October and November CPI data has left the Federal Reserve and market participants without a clear view of current price dynamics. Projections for the November CPI, based on the Cleveland Fed's nowcast and private forecasts, suggest inflation will hover near 3% year-over-year, marking the sixth consecutive month of rising inflation after earlier declines. Core inflation measures, excluding food and energy, are expected to remain sticky, with services inflation outpacing goods inflation. 3.2. Inflation expectations and consumer sentiment. Despite realized inflation running above the Federal Reserve's 2% target for 5 years, medium and long-term inflation expectations remain relatively well anchored, according to surveys from the University of Michigan and the Philadelphia Federal. The November 2025 median long-run inflation expectation fell to 3.4%, below the peaks of April 2025 and June 2022, but still above pre-pandemic levels. The interquartile range, a measure of uncertainty, has eased but remains elevated relative to historical norms. However, consumer sentiment remains near record lows, with the University of Michigan's Consumer Sentiment Index falling to 51 in November, just above its all-time low of 50 in June 2022. Persistent concerns about affordability, high prices, and weakening incomes are weighing on household expectations and spending plans. 3.3. Implications of weak inflation data. A weak November inflation print, characterized by deceleration in headline and core CPI/PCE, would have nuanced effects. It could reinforce the case for Federal Reserve rate cuts, especially if accompanied by weak labor market data and softening consumer demand. However, if inflation remains stubbornly above target, particularly in core services, the Fed may be forced to maintain a cautious stance, delaying further easing and risking a higher for longer rate environment. Persistent inflation uncertainty complicates business planning, wage negotiations, and investment decisions, especially in sectors sensitive to input costs and pricing power. The interplay between inflation and labor market weakness is central to the Fed's dual mandate and will shape the policy response in the coming months. 4. GDP implications. Weak Q4 print and shutdown effects. 4.1. The direct economic impact of the shutdown. The Congressional Budget Office, CBO, estimates that the 43-day shutdown will reduce annualized real GDP growth in Q4 2025 by 1.0 to 2.0 percentage points, depending on the scenario. The primary channels of impact include delayed federal spending on employee compensation, goods and services, and SNAP benefits, totaling between $74 billion and $84 billion in the 8-week scenario. Reduced aggregate demand as furloughed workers and contractors cut back on consumption. Temporary reductions in private sector output due to lower government demand and uncertainty. While most of the lost output is expected to be recovered in early 2026 as federal spending rebounds, the CBO projects that between $7 billion and $14 billion in real GDP will be permanently lost, primarily due to the reduction in hours worked by furloughed employees. For point 2, GDP nowcasting and alternative estimates. The Atlanta Fed's GDP Now model, which aggregates real-time data to estimate current quarter GDP growth, projected a robust 4.2% annualized growth rate for Q3 2025, reflecting strong consumer spending and business investment prior to the shutdown. However, forecasts for Q4 have been revised downward, with most analysts expecting growth to slow to the 1 to 1.5% range, or even lower if the delayed data confirms a significant drag from the shutdown and weak labor market conditions. The Conference Board estimates that the shutdown could shave roughly 0.5 percentage points off Q4 GDP growth, with most of the loss likely to be recovered in early 2026. However, the risk of a more persistent slowdown remains if consumer and business confidence fail to rebound. 4.3. Implications of a weak Q4 GDP print. A weak Q4 GDP print would confirm the negative economic impact of the shutdown, reinforcing concerns about the resilience of the recovery. Increase pressure on policymakers to implement fiscal and monetary stimulus, especially if the labor market and inflation data also disappoint. Undermine investor and business confidence, potentially triggering a self-reinforcing cycle of reduced spending, hiring, and investment. The magnitude and persistence of the GDP slowdown will depend on the speed of the post-shutdown rebound and the effectiveness of policy responses. 5. Federal Reserve policy response. Rate cuts, timing, and communications. 5.1. The Fed's data-dependent dilemma. The Federal Reserve's approach to monetary policy is explicitly data-dependent, with interest rate decisions guided by the latest readings on inflation, employment, and economic activity. The shutdown-induced data vacuum has forced the Fed to rely on stale information, alternative data sources, and anecdotal evidence, increasing the risk of policy missteps and internal divisions within the Federal Open Market Committee, FOMC. At its September and October meetings, the Fed cut the federal funds rate by a total of 50 basis points, citing weak employment trends and growing risks to the labor market. However, the December meeting presents a unique challenge. The November jobs and inflation reports will not be available until after the meeting, leaving policymakers to make a crucial decision without the most current data. 5.2. Internal divisions and market expectations. Minutes from recent FOMC meetings reveal a split among policymakers. Several members support another rate cut in December, arguing that the risks to employment outweigh concerns about persistent inflation. Others advocate caution, citing inflation still above target and the dangers of acting without complete information. Market expectations, as reflected in the CME FedWatch tool, have fluctuated widely, with the probability of a December rate cut swinging between 35% and 83% in recent weeks. The uncertainty has contributed to heightened market volatility and reduced liquidity in interest rate-sensitive sectors. 5.3. Communications and risk management. Fed officials, including Chair Jerome Powell and Governor Christopher Waller, have emphasized the importance of risk management and flexibility in the current environment. They have signaled a willingness to adjust policy as new data becomes available, while cautioning against overreacting to incomplete or potentially misleading indicators. The possibility of delaying the December meeting to await the November jobs report has been raised by some analysts, though historical precedent for such a move is limited. Regardless of the timing, the Fed's communications will be critical in managing market expectations and maintaining credibility. 5.4. Implications of a weak November data release. If the November data, when finally released, confirms a significant slowdown in jobs, inflation, and GDP, the Fed is likely to proceed with further rate cuts in early 2026, potentially accelerating the pace of easing if labor market weakness persists. Halt or slow the runoff of its balance sheet to support liquidity in money markets. Emphasize its commitment to the dual mandate, with a renewed focus on supporting maximum employment. However, if inflation remains stubbornly high, the Fed may be forced to maintain a cautious stance, risking a prolonged period of restrictive policy and elevated market volatility. 6. Market volatility and asset class reactions. 6.1. The immediate market response to the data vacuum. The shutdown-induced data blackout triggered a period of heightened market volatility, with major equity indices experiencing both sharp declines and relief rallies as investors reacted to news of the shutdown's resolution and the prospect of delayed data releases. The CBOE Volatility Index, VIX, spiked, reflecting increased uncertainty and risk aversion. Interest rate-sensitive sectors, such as real estate, financials, and consumer discretionary, were particularly affected, as the absence of clear economic signals made it difficult to price assets and assess risk. Defensive sectors, including utilities and consumer staples, attracted increased investor interest as safe havens. 6.2. Winners and losers in a data-scarce market. The delayed release of economic data and the prospect of a weak November print have created distinct winners and losers among public companies and sectors. Potential winners. Real estate developers and home builders, e.g., D.R. Horton, Lennar, could benefit from lower interest rates if the Fed accelerates rate cuts in response to weak data. Growth-oriented technology firms may see renewed investor interest as lower rates make future earnings more attractive. Defensive sectors, utilities, consumer staples, healthcare, are likely to outperform in a volatile, uncertain environment. Companies with strong balance sheets and low debt levels are better positioned to weather unpredictable rate movements. Potential losers. Banks and financial institutions may struggle with reduced loan demand and increased credit risk in a weak economy, despite initial benefits from higher net interest margins. Highly leveraged companies and cyclical industries, manufacturing, energy, industrials, face increased borrowing costs and reduced demand. Export-dependent firms may be hurt by a stronger U.S. dollar and global economic uncertainty. 6.3. Asset class reactions and strategic positioning. Equities. Developed market equities have shown resilience, supported by strong corporate earnings in select sectors, notably AI and technology, but remain vulnerable to volatility as delayed data is digested. Fixed income. Treasury yields have fluctuated in response to shifting rate expectations, with periods of flight to safety and renewed risk appetite. Commodities. Gold and other safe haven assets have attracted inflows during periods of heightened uncertainty. Currencies. The U.S. dollar has strengthened against major currencies, reflecting relative growth resilience and trade deal progress, but may face depreciation as interest rate differentials narrow. Investors are advised to maintain diversified portfolios, focus on quality companies with strong fundamentals, and remain vigilant for further volatility as new data is released and policy responses evolve. 7. Investor sentiment and positioning. Flows, risk premia, and liquidity. 7.1. The erosion of confidence and the search for clarity. The prolonged data blackout and the prospect of weak November data have eroded investor confidence, leading to increased caution, reduced liquidity, and a reassessment of risk premia across asset classes. The absence of reliable economic signals has forced investors to rely on alternative data, anecdotal evidence, and sentiment-driven positioning, increasing the risk of mispricing and abrupt market corrections. 7.2. Flows and positioning. Equity flows. Flows into defensive sectors and large-cap technology have dominated, reflecting a preference for stability and growth in uncertain times. Fixed income flows. Investors have rotated into short-duration treasuries and high-quality corporate bonds, seeking safety and yield. Liquidity conditions. Liquidity is tightened in certain markets, particularly those sensitive to interest rates and credit risk, as investors await clearer signals from economic data and the Federal Reserve. 7.3. Risk premia and market dynamics. Risk premia have widened in sectors and asset classes most exposed to economic uncertainty, including high-yield credit, small-cap equities, and emerging markets. Conversely, risk premia have compressed in perceived safe havens, leading to elevated valuations in select sectors. The potential for a data deluge, as backlogged reports are released, raises the risk of sharp market moves and rapid repositioning, especially if the data surprises to the downside or upends prevailing narratives. 8. Consumer confidence and spending implications. 8.1. The collapse in consumer sentiment. Consumer confidence has deteriorated sharply in the wake of the shutdown, with the University of Michigan's Consumer Sentiment Index falling to near-record lows in November. Persistent concerns about affordability, high prices, and weakening incomes have weighed on household expectations, particularly among lower and middle-income consumers. The shutdown's impact on federal workers, SNAP beneficiaries, and recipients of other government services has been especially pronounced, with delayed paychecks and benefit disruptions exacerbating financial stress. 8.2. Spending patterns and vulnerabilities. Affluent households, higher-income consumers have remained relatively resilient, supported by strong balance sheets and equity market gains. Lower and middle-income households. These groups are more vulnerable to job losses, inflation, and benefit disruptions, leading to reduced discretionary spending and increased credit delinquencies. Durable goods and housing. Spending on big-ticket items has slowed, reflecting caution amid high interest rates and uncertainty about future income. The risk of a broader consumer spending slowdown is heightened if labor market weakness persists and confidence fails to recover. 9. Business confidence, investment, and hiring plans. 9.1. Main Street and corporate America. Diverging fortunes. Small business confidence is near record lows, with the Fall 2025 Main Street America survey reporting the second lowest average rating since tracking began. Over the past 3 months, 38% of small businesses reported a decline in revenue, and 45% saw a drop in net profit. Concerns about the shutdown, tariffs, inflation, and shifting consumer spending patterns have weighed heavily on operational decisions. Larger corporations, particularly those with strong balance sheets and diversified revenue streams, have fared better, but remain cautious about capital expenditures and hiring in the face of policy uncertainty and volatile demand. 9.2. Investment and hiring plans. Capital expenditures. Investment plans have been delayed or scaled back, especially in sectors exposed to regulatory bottlenecks, trade policy uncertainty, and weak demand. Hiring. Businesses are adopting a no-hire, no-fire equilibrium, holding off on new hires while avoiding layoffs where possible. However, sectors facing automation, trade shocks, or persistent weakness are implementing job cuts and attrition. Credit conditions. Banks have tightened lending standards for small businesses and firms with high trade exposure, while easing terms for large, creditworthy borrowers. The bifurcation between prime and subprime borrowers, and between large and small firms, is becoming more pronounced, raising concerns about rising inequality and the risk of a K-shaped recovery. 10. Financial sector and credit conditions. 10.1. Credit tightening and selective lending. The Federal Reserve's Senior Loan Officer Opinion Survey, SLS, for Q3 2025 revealed a cautious stance from banks, with tightened lending standards for commercial and industrial (C&I) loans, especially for small businesses and firms with high trade exposure. Demand for loans from large and middle-market firms has strengthened, driven by inventory building and M&A activity, but small business loan demand remains flat. On the consumer side, banks are more likely to approve credit card applications for superprime and prime borrowers, while tightening access for subprime borrowers. Delinquencies on subprime vehicle loans have hit their highest level since 2010, and credit card losses have receded only slightly as issuers tighten conditions. 10.2. Implications for financial stability. Banks and financial institutions. Profitability is challenged by reduced loan demand, increased credit risk, and uncertainty about future rate movements. Small businesses. Access to credit is becoming more constrained, exacerbating operational challenges and increasing the risk of insolvency. Households, rising delinquencies and tighter credit conditions are likely to weigh on consumer, spending, and financial stability, particularly among vulnerable groups. The risk of a credit crunch is mitigated by strong balance sheets among large firms and prime borrowers, but the divergence between winners and losers is widening. 11. Fiscal and political responses to weak data and the shutdown aftermath. 11.1. Congressional and administrative actions. The resolution of the shutdown was achieved through a narrow, bipartisan vote, extending federal funding through January 30th, 2026, and bundling 3 full-year appropriations bills with a stopgap extension. However, the underlying political divisions remain unresolved, with further budget negotiations and potential shutdown risks looming in early 2026. House and Senate leaders have expressed a desire to advance additional spending bills and address expiring tax credits and healthcare subsidies, but the window for action is rapidly closing. The uncertainty surrounding future fiscal policy is contributing to market volatility and undermining confidence in U.S. economic stewardship. 11.2. Fiscal stimulus and safety net programs. The shutdown disrupted the disbursement of SNAP benefits and other safety net programs, disproportionately affecting low-income households and exacerbating regional disparities. The resumption of federal spending is expected to provide a temporary boost to GDP and consumer spending in early 2026, but the risk of further disruptions remains. Calls for targeted fiscal stimulus, including support for affected workers, small businesses, and vulnerable communities, are likely to intensify if the November data confirms a significant economic slowdown. 12. Short dash, medium dash, and long-term strategic implications. 12.1. Comparative table, short dash, medium dash, and long-term impacts. 12.2. Analysis and strategic recommendations. For policymakers, prioritize data integrity and timely reporting. Consider targeted fiscal support for vulnerable groups. Maintain flexibility in monetary policy and clear communication to manage expectations. For businesses, enhance operational resilience through supply chain diversification, cash flow management, and scenario planning. Invest in automation and digital capabilities to adapt to structural shifts. For investors, maintain diversified portfolios, focus on quality and resilience, and remain vigilant for further volatility as delayed data is released and policy responses evolve. For households, build precautionary savings, monitor employment prospects, and seek financial counseling if facing hardship due to benefit disruptions or job losses. 13. Inflation risks and disinflation scenarios. 13.1. Risks of persistent inflation. The risk of persistent inflation remains, particularly if core services inflation proves sticky and wage growth accelerates in response to labor market tightness in select sectors. New tariffs and supply chain disruptions could add to price pressures, complicating the Fed's efforts to achieve its 2% target. 13.2. Disinflation scenarios. If demand remains weak and labor market slack persists, inflation could decelerate more rapidly than expected, allowing the Fed to accelerate rate cuts and support a broader recovery. However, the risk of a stop-start disinflation, with periods of renewed price pressures, cannot be ruled out. 14. Alternative data and nowcasting methods used during the shutdown. The shutdown forced policymakers and analysts to rely on alternative data sources and nowcasting models, including private payroll reports, ADP, Indeed, LinkedIn, state-level unemployment insurance claims, real-time consumer spending data from credit card processors and fintech firms, business surveys, Census Bureau's business trends and Outlook survey, regional Fed surveys, nowcasting models for GDP and inflation, Atlanta Fed GDP Now, Cleveland Fed Nowcast. While these sources provided valuable insights, they lack the comprehensiveness and methodological rigor of official government statistics, underscoring the critical importance of uninterrupted data collection. 15. Historical precedents, past shutdowns and data gaps effects. Historical analysis of past shutdowns, 2013, 2018 to 2019, reveals that short shutdowns have muted effects on GDP and markets, with most lost output recovered quickly. Prolonged shutdowns lead to more significant economic consequences, including permanent loss of output, delayed payments to contractors, and erosion of confidence. Data gaps complicate policy decisions and increase the risk of missteps, as seen in delayed or revised rate moves by the Fed. The cumulative effect of repeated shutdowns erodes trust in U.S. governance and fiscal stability, potentially raising borrowing costs and undermining the dollar's reserve currency status. 16. Policy coordination and international spillovers. The U.S. shutdown and data blackout have ripple effects beyond domestic borders. Policy divergence between the Fed and other major central banks, ECB, BOJ, can impact currency exchange rates, trade balances, and capital flows. Global markets are sensitive to U.S. policy signals, with volatility in equities, bonds, and commodities reflecting uncertainty about the U.S. outlook. Erosion of international trust in U.S. economic stewardship may have long-term consequences for global financial stability and the dollar's role in the international system. 17. Conclusion: navigating the new normal. The weak November economic data release, set against the backdrop of the longest government shutdown in U.S. history, represents a critical test for the resilience of the U.S. economy, the effectiveness of policy responses, and the adaptability of businesses and investors. The data vacuum has magnified existing challenges: persistent inflation, labor market fragility, political dysfunction, and introduced new risks, including the potential for policy missteps and lasting economic scars. Moving forward, the path to recovery will depend on the speed and effectiveness of policy responses, the restoration of data integrity, and the ability of households, businesses, and investors to adapt to a more volatile and uncertain environment. Vigilance, flexibility, and a renewed focus on resilience will be essential as the U.S. economy navigates the aftermath of the shutdown and the challenges ahead. Key takeaways: the 43-day government shutdown has created a fog of uncertainty, delaying critical economic data and complicating policy decisions. A weak November data release could trigger heightened market volatility, accelerate Fed rate cuts, and undermine confidence across the economy. A labor market weakness, persistent inflation, and a slowdown in GDP growth are central risks, with disproportionate impacts on vulnerable households and small businesses. Policy responses must prioritize data integrity, targeted support, and clear communication to restore confidence and support recovery. The experience underscores the foundational role of timely, accurate economic data in maintaining market stability and guiding effective policymaking. What to watch in the coming months: the release and interpretation of delayed jobs, inflation, and GDP reports. The Federal Reserve's policy path and communications, especially regarding rate cuts and balance sheet management. Trends in consumer and business confidence, spending, and investment. Credit conditions and access to financing for small businesses and vulnerable households. Political developments and the risk of further fiscal disruptions as new budget deadlines approach. International spillovers and the response of global markets to U.S. economic signals. The lasting impact of this episode may well be a renewed appreciation for the foundational role of economic statistics in policy formulation and a push for greater resilience in data collection and dissemination. In an increasingly data-driven world, a blackout of information is tantamount to a blackout of economic foresight, with potentially significant and enduring consequences. P.S. Feel free to check out my sponsored snack section in the show notes, where we have our brand deals for multiple companies selling snacks and other such good items.